now for our special segment Alpha Managers, and joining in now to discuss his strategies, stock bets and of course what investors should do in turbulent times like this. S Naren, the CIO of ICICI Prudential Asset Management, joins in. Hi Naren, good to see you in. We need calming voices at a time when the market is so turbulent. What is the strategy that long-term retail investors should adopt now? Because for the last, say, 6 to 12 months, the only strategy that has been advocated is, invest into mutual funds in a staggered manner. Now, when you see a lot of global volatility, do you recommend sitting on cash, or do you think that one should continue doing what they did up until now?
See, over the last 6 months to 1 year, we've been recommending investors to both invest in fixed income and invest in hybrid strategies like the balanced strategies. I believe that, now given the way the markets have shaped up, it is possibly something we are worth considering investing more aggressively by looking at pure equity strategies on a lump sum basis also, instead of only on systematic investment plans or systematic transfer plans. The reason being is that in our framework of investing, we like people to invest lump sum when there is fear. As you know, today there is fear. When there is past returns are bad. Today, for example, that the 1 year return on the index is now negative. And when you see big FII selling. So at this point of time, all these 3 points are being ticked. So, and therefore we think it is a good time to consider lump sum investing. Having said that, can you get mega returns in equity? It doesn't look likely. I believe that you can get decent returns in equity. To get mega returns in equity, you need GST, land bill, sharp cuts in interest rates, resolution of the infrastructure bad debt problem, improvement in the real estate markets. I think all these things happen, you can get very good returns, but otherwise you should prepare yourself to invest today with a decent return possibility.
Okay, Naren, hi, good afternoon. Just going through some of your recent portfolio changes, and a couple of things stand out, and you can correct me if I'm wrong. One is that it looks like you've started to take some more bets in the metal sector, and you're a bit negative on pharma. If you could first tell us if that is right, and what would your reasons be for these positions?
See, it's actually very simple. If you look at a sector, the best time to invest is when there is blood on the street. And this is something which has worked for the last 50, 60 years. If you look and see which is the sector where there is blood on the street, it is metal sector. I think most of the companies are loss-making, and there is a possibility of huge bad debts if the current situation happens to some of the weaker metal players. And in my career in investing, I've seen that if you invest when there is blood in the street in a sector, whether it be textile, whether it be sugar, whether it be metals, whether it be banks, I think there is very good potential for long-term investing in that sector. But today, given the fact that on the other hand, if you see the pharma sector, everything is going for them. There are hardly any problems, things are doing well. Valuations are expensive, so you need to have some funding sources to buy the sectors in deep trouble which are extremely cheap. So the pharma sector sell-off is not due to anything due to the fundamentals of the sector. It is due to the fact that the other sectors are very, very cheap rather than pharma being either very costly or in trouble.
Okay, fair enough. So, just coming back to the point you made about not expecting too much by way of returns in this market, what kind of realistic returns can one expect for the next, say, 6 to 12 months? Given that, if this China situation gets worse, then the global liquidity could be crimped down. For India particularly, what returns can one expect?
See, actually, I can give you a number, and it is very easy to give a number of 10 to 15% or 10 to 20%. The fact is, no one goes right in these numbers. Show me a person who expected 8,000, sub 8,000 Nifty in August at the beginning of July or something like that. So I think no one gets right on numbers. Having said that, I think we get too worried about global events. As you know, we've seen Italy, we've seen Spain, we've seen Greece, we've seen Ukraine, at one point of time Dubai. So periodically you will have global problems, and the time to invest lump sum in equity would be during global problems. If everything was smooth, you would have huge FII buying, and maybe not the time to invest in a very aggressive manner. So I would say that it's good for the Indian investors that you have these periodic global problems to give people opportunities to invest, considering that at this point of time, if you see mutual fund equities is around 50 to 60 billion dollars, whereas FIs is about 330 billion dollars. So I think these periodic corrections which come due to global reasons is an opportunity for Indian investors to increase their position. Otherwise, bulk of our market is now foreign owned.
Your top holding in two funds is par grade. I know you would not want to talk stock specific, but for a lot of fund managers, government company and that too in par sector would be a strict no-no. What makes you so bullish on this space if you don't want to talk about individual company?
See, it's simple. I think, if you look at the entire return expectation that we had since the beginning of the year, it was never what the market gave in 2013-14. It was lower than that, and therefore regulated utility with a very clear outlook till 2019 makes the stock very relatively safe, because it's a regulated utility where the returns are fixed as per CERC rules. So, and from an investing point of view, I think today PSUs are certainly one of the more interesting areas to invest in, given that over the last 5 to 10 years, hardly any money has been made in PSUs. So many of those sectors many of those stocks have got derated, they have become very cheap. And the good thing actually many of these PSUs have is they have very strong balance sheets. And actually, if you look at what can happen to the economy in the next 3 to 5 years, I would say that it is the PSUs who have the balance sheet to implement new projects and grow. Whereas if you see the private sector and many of the infrastructure related players, they are actually having stretched balance sheets and consequently not in a position to expand. So I actually think PSUs in the infrastructure space, which have good balance sheets, have one of the best outlooks for the next 3 to 5 years. You're getting them cheap, the valuations are very cheap, and the outlook seems to be reasonable with a 3 to 5 year view. So which is how we are looking at it, and these are not, and it's only the PSUs who have the ability to implement a capex cycle at this point of time. I think the market also recognizes it slowly.
Okay, that's an interesting take on PSUs. We'll come to the PSU banks in a bit. But before that, I also noticed that you've recently increased your exposure in the auto sector. And one of your top holdings that you have in the dynamic plan is Tata Motors. That is one stock that has, shocked the street with its derating. What do you do at a time like this? Do you keep the faith and hold on to these companies because of the pedigree of the management, or do you start to perhaps trim your positions here?
See, in the dynamic plan, we've always pursued a counter-cyclical strategy to look at sectors in trouble where the long-term outlook is very good and the valuations are very attractive. And that is a strategy we have followed over a long period of time as part of the process. So we are always on the lookout for areas where we think the long-term outlook is very good and where the current valuation is very reasonable. And we keep looking at stocks and sectors for investment in this manner. Our experience over a long period of time has been that such a framework is conducive for long-term investing. And if you see most of the global investment gurus, they recommend investing counter-cyclically in a value framework for long-term investment returns. And today is one such opportunity where you have wide divergence in valuations, and you have some sectors which are very, very cheap and some stocks which are very, very cheap, and whose long-term outlook continues to be very good with doubtful short-term outlook. And we believe that such an approach should actually lend itself to very good long-term investing. There are always risks in the short run, and they will continue to be there.
Okay, that point is taken. Naren, one space where investors have made a lot of money is oil and gas sector, at least in some stocks like the HPCLs and BPCLs of the world, the oil marketing companies. It looks like you have decided to book profit in this space, because in your latest holdings, that is not part of your top holdings. Do you think the most of the crude story is now priced in some of these stocks?
See, our view on the oil marketing space has been that essentially they are regulated entities whose profits are likely to be more like a regulated return company. So when a sector like this is very cheap, it makes sense to actually invest in it. And if the sector does become costly, I think then we actually see whether it makes sense to hold on, or we see other regulated return stocks trading much cheaper where we can actually invest in. That has been our investing framework, and I think for the market to believe that every drop in oil leads to an increase in margins of the oil marketing companies is not logical. So we don't think, we do agree that over the last few years, the entire problems of the oil marketing companies have been resolved. And with diesel and petrol pricing being freed, we have a reasonably interesting regulatory framework. Having said that, I don't think the profits in that industry are inversely correlated to crude, as the market seems to think it is, and that's where the difference between us and the market in that sector exists.
Okay, by the way, just keep one eye on the market as well, because now the market is gravitating towards the low point of trade again. There is no conclusive attempt to recover at all. In fact, the Sensex is down about 250 points now, and the Nifty is back towards the low point at about 7,800 or so. Naren, you have been through many of these cycles, where you have, patches of panic, and then once again you see a swift recovery. How different is this time from 2008? I don't mean to compare it in the sense of, a major crisis, but this time there's so many uncertainties. At least in 2008, we had one swoop of a fall, and we knew the reasons for that. But now no one seems to know how bad the Chinese situation can get. So how do you wade through a patch like this?
See, if you look at Indian macro, I think it's in the best shape that I can think of. Look at fiscal deficit, current account deficit, and inflation. So I think if you start worrying about every problem in every part of the world, then you will never be able to invest in equity market till it becomes 25 PE. So when the market is 25 PE, I think at that point of time everything will be looking good. Every economic data maybe will be looking good. So through this period of looking at markets, I've seen that the best times to invest in equity is when there is pessimism, when past returns are bad, and when I see a little bit of panic. And I see that today, not in the domestic market, thankfully, but in the global investors' behavior. So just think about it. At the year's low, you see FIIs selling at this point of time. When crude is so low, inflation is coming down, there's potential for interest rate drops. And at that point of time, we are seeing selling from FIIs. Is that an opportunity for the domestic investor? Certainly. So our view has been that, and what I've seen is it is years like 2007 where I worry about. In years like 2008, I think are opportunities for investors, and the current correction is again an opportunity for investors. And if you keep waiting for all the problems to get resolved, then I don't think equity investing is not about investing when everything is perfect. In fact, we did some work and found out that the best time to invest in equities is when industrial production growth is very low, fiscal deficit is very high, and credit growth is very low. Okay. And the worst time, the best time to take out money from equities is when credit growth is very high, fiscal deficit is very low, and industrial production growth is very high. So why this works is because equities as an asset class, you have to invest into problems and take out money when everything is all right. That's a model which works. And so that's why for us, this correction at this point of time, we see it as an opportunity. We believed in volatility right through. Now we think with this correction, there is scope for investing more aggressively rather than less aggressively. We will know only later which was that exact bottom point. But, you know, one thing I was telling my colleagues today, that somehow in August, market corrections happen. If you see August 2011, August 2013, August 2015. So one of my colleagues pointed out that we have to start worrying about odd years August, because in those years market seems to correct substantially. So I think August is a good month to invest, unlike what Mark Twain says. And I think that opportunity has presented itself to investors. Indians are underinvested. So I see this as an opportunity rather than a problem.
Okay, by the way, the Nifty is now below 7,800 at the low point of the day now. Sensex falling 300 points. The mid-cap index reversal has been rather swift. The mid-cap index now trading in the red. Naren, I take your point on, you know, the FIs selling, and it's really been curious case that, you know, the history is repeated in terms of the kind of selling that we have seen from FIs and buying again at historic high levels. But is this a risk given the fact that the domestic mutual funds are sitting on very low cash levels, are almost fully invested, and so far, you know, the flows are supporting, the domestic flows are supporting the market. What if because of this global panic, we start seeing, you know, redemption pressure or slowdown in domestic funds as well? Would that be a bit of a big risk to the market going forward?
See, I think number one is equities is a riskier asset class than fixed income. I spent the better part of the last 1 year explaining to people that debt mutual funds like the short-term varieties are much safer than equities. Over the last 1 year, people have tended to believe that equities is not a risky asset class. So I think the current correction has possibly will get people to realizing that debt is a safer asset class than equities. Having said that, I think, you know, for example, if you take ICICI Mutual Fund as a house, we do have strategies where we do keep cash when the market's valuations are higher. So in those strategies, we do get an opportunity to keep buying as the market goes down. It is true that given the quantum of FII investment which exists, if every day FIs keep selling, the market will come down. But I would say that if the market keeps coming down, it means more opportunity for you. And as such, you know, investing at possibly the year's low point is adds to some margin of safety. I believe as part of investing when the market is at a 52-week low is much safer than investing when the market is at 52-week high. So from my framework, I find that market is possibly a safer place to invest today because implied assumptions are lower than what it was when the market touched nearly 30,000 this year. So I would say the market is more safe now, and I believe that equities as an asset class will be volatile. And to make the best money in the asset class is when you buy in panic and sell in euphoria.
Sure.
And I do agree that maybe every day if FIs keep selling, markets may come down. But I don't worry about it. I see every day it falls. If it falls, I think that adds to the opportunity for people who are underinvested. So I see these as opportunities, and I don't get too worried about them when they fall, because I think it adds to the merit of the asset class, doesn't reduce the merit of the asset class. You would all agree that with oil being what it is, India's macro is possibly never been better, and you would agree that it can lead to big interest rate drops over a period of time, which can actually reduce the cost of capital for Indian industry, leading to a good potential return. Having said that, I do believe debt mutual funds are very, very attractive at this point of time, because you're in a deflationary environment, and in a deflationary environment, debt has proved to be the best asset class everywhere in the world. So I would always believe that in a deflationary environment, people should also consider investing in debt mutual funds.
Okay, by the way, the Nifty is now below the 7,800 mark, and there is a sudden collapse that we've seen in some of the banking names. So HDFC is now down 4%. Just take a look at that intraday chart. There has been quite a bit of selling pressure there this week. HDFC has lost about 10% this week already. IndusInd Bank, SBI and Bank of Baroda are down about 2 to 3 odd percent. Naren, this is the opportunity that you have perhaps been looking for, the way the banks have fallen, and you have recently increased your exposure in the banking space. In fact, in your dynamic plan, banks form almost 20% of your portfolio. Within banks, what looks like the more lucrative opportunity? Is it private banks, or would you now start looking at PSUs?
See, I think clearly retail-oriented banks are possibly best positioned in the near term, given that the corporate capex cycle seems to be delayed, and you're not seeing a high increase in credit growth to corporate India. So maybe in the near term, we have been believers in sectors like retail-oriented banks and financial services companies focused on insurance and those kind of things at this point of time. The recent Indradhanush announcement could mean that over a period of time, PSU banks may also emerge as attractive investments. Having said that, I think in the near term we would want to see the NPLs in the sector go down and credit growth to pick up. So I would say that banking looks interesting from a long-term point of view.
Okay. By the way, the market is now seeing deep cuts. And really, HDFC, it was there in the numbers yesterday, Sonia, as I pointed out in the morning as well, the kind of delivery-based selling you saw in HDFC and the kind of selling that you have seen all through this month was telling you that this really is institutional selling and some portfolios lightening positions in a stock like HDFC. Otherwise, it doesn't fall like that. But Naren, you spoke about debt mutual fund as well, and increasing exposure to debt, and debt has done reasonably well, especially given the way we have seen global markets. At least that's one market which has remained quite stable over the last week or so. How much percentage of portfolio would you now suggest investing in debt, and how much in equities from current levels?
See, these are numbers which are difficult to answer, but I have been telling people, I've been telling our distributors that each of them should actually build a sizable portfolio in debt mutual funds, given that in a deflationary environment everywhere in the world, debt has proved to be an outstanding asset class. The problem is that in the recent past, except after this correction, equities were always giving you double-digit returns. So people were very reluctant to consider debt mutual funds. But I think, it is very important that investors have money in debt mutual funds, equity mutual funds, and balanced kind of funds in their portfolio, because I think only if you have a balanced portfolio involving debt, equity and balance, do you have comfort. So, if you see the deep market cuts we have seen in equities over the last 1 week, if you had only an equity oriented portfolio, the losses would have been reasonably significant. So we advocate an asset allocation framework involving debt mutual funds, equity mutual funds and balance funds for long-term investment.
All right, Naren, we leave it at that. Thank you for staying with us for a while and through this market mayhem. Well, buy in panic and sell in euphoria. That's the word coming in from ICICI Prudential. Get